Uncle Ton retired 11 years ago. He never touched his portfolio during the 2008 crash, never sold during COVID, never panicked when the market dropped 15% in a single month. But here's what's strange. When his nephew showed him a growth stock that had returned 18% a year for the past decade, Uncle Ton shook his head and said, "Too risky." Then, without hesitation, he put $50,000 into a REIT paying 5% a year. A REIT that had actually lost value over that same decade. Why would someone reject the better investment and choose the weaker one? If you've spent any time around Singaporean investors, you already know the answer. You've probably felt it yourself. There's a phrase you'll hear in almost every kopitiam conversation about money. As long as got dividend, can already. Not as long as it grows, not as long as the company is strong, just as long as it pays you something, regularly, predictably. This isn't a Singapore-only phenomenon, but here it runs unusually deep. And once you understand why, you'll start noticing it everywhere. In your parents' portfolios, in your colleagues' CPF top-up strategies, maybe even in your own instincts. Let's start with a comparison. In the United States, ask an investor what they're chasing, and most will say growth. They want the next Amazon before it becomes Amazon. They're comfortable holding a stock that pays no dividend at all as long as the share price keeps climbing. In Singapore, ask the same question, and the answer shifts. People want yield. They want a number that lands in their bank account every quarter. Ask a Singaporean uncle about his portfolio, and he won't tell you his annual return. He'll tell you his dividend yield. This isn't because Singaporeans don't understand compounding. Many do, mathematically. The disconnect isn't intellectual, it's psychological. To understand it, you have to go back further than the stock market. You have to go back to how an entire generation was taught to think about money. Singapore's economic story is only about 60 years old. Within living memory, this was a nation with no natural resources, uncertain political footing, and a population that had lived through real scarcity. The people who built modern Singapore didn't grow up trusting markets. They grew up trusting cash in hand. That mindset didn't disappear. It got passed down. If your parents or grandparents lived through the uncertainty of Singapore's early independence years, you likely absorbed a quiet rule without ever being told it directly. Money that isn't in your hand isn't real yet. A rising share price is a promise. A dividend payment is a fact. And when trust in promises is low, facts win. There's something else happening too, something structural rather than cultural. Singapore built an entire national identity around income security. CPF itself is designed around guaranteed payouts, not market speculation. HDB policy assumes stable, predictable financial planning across decades. Even government messaging around retirement centers on one word again and again: adequacy, not growth, adequacy. When your entire financial infrastructure is engineered around steady, reliable income, is it any surprise your instincts follow the same pattern? You've been trained, structurally, to prefer the bird in hand. Now here's where it gets interesting, because this preference isn't irrational. It's not simply Singaporeans are bad at investing. In many ways, this instinct is protective. Someone who needs certainty, who can't tolerate watching their portfolios swing wildly, who might need to access funds for a home renovation or a parent's medical bill. For that person, a REIT paying steady income might genuinely be the smarter emotional choice, even if the math says otherwise. But here's the problem. Most people don't consciously choose this trade-off. They don't sit down and decide, I am willing to accept lower long-term growth in exchange for psychological comfort. They simply feel uncomfortable with growth stocks and gravitate toward dividends without ever naming why. And that's where the real cost hides. Let's put numbers to it, because numbers make this uncomfortably clear. Imagine two people, both starting with $50,000. The first person buys a dividend-focused REIT portfolio yielding 5% annually with modest price appreciation of around 1% a year. Over 25 years, assuming dividends are reinvested, that portfolio grows to roughly $180,000. The second person buys a diversified, growth-oriented portfolio, something like a broad global equity fund, averaging 8% annual returns with no dividends at all. Same $50,000, same 25 years. That portfolio grows to over $340,000. Same starting point, same time horizon, nearly double the outcome. The dividend investor didn't do anything wrong exactly. They just optimized for a feeling instead of a number. They wanted to see money arrive every quarter, so they accepted a smaller total outcome in exchange for that regular reassurance. This is what economists sometimes call the dividend illusion. A dollar paid out as a dividend and a dollar of unrealized capital gains are mathematically identical in value, but psychologically they feel completely different. One feels earned, real, safe. The other feels like a number on a screen that could vanish tomorrow. Your brain doesn't evaluate wealth the way a spreadsheet does. It evaluates wealth the way a nervous system does, and nervous systems trust what they can touch. So where does this leave you? Not with a verdict that dividends are bad or that growth stocks are always superior. That would be its own kind of oversimplification. It leaves you with a more useful question. Are you choosing income because you've calculated that it fits your actual life circumstances, or are you choosing income because it quiets an anxiety you've never fully examined? Those are two very different decisions that happen to look identical on a brokerage statement. Someone 5 years from retirement who needs predictable cash flow to cover living expenses has a legitimate reason to prioritize income. Someone 28 years old with decades of runway ahead, chasing 5% yield instead of long-term growth, might simply be paying an emotional tax without realizing it. Here's where most people stop thinking about this. They pick a strategy once in their 20s or 30s based on whatever felt safest at the time, and then they never revisit it. The REIT they bought at 26 becomes the REIT they still hold at 55, not because they reevaluated it, but because it became habit disguised as strategy. But the smartest investors, the ones who actually build significant wealth over decades, do something different. They separate the emotional need for reassurance from the mathematical need for growth. Sometimes that means holding a small allocation of dividend-paying assets specifically for psychological comfort, while letting the majority of their portfolio compound quietly in growth assets they don't check every day. It's not about eliminating the desire for income. It's about being honest about what that desire is actually costing you and deciding, consciously, whether the trade is worth it. Uncle Tan's portfolio isn't wrong. For a retiree who needs monthly cash flow and sleeps better seeing that number hit his account, income investing might be exactly right. But if you're not Uncle Tan yet, if you're still decades away from needing that certainty, the question worth sitting with tonight isn't whether dividends are good or bad. It's whether the safety you're chasing is protecting your future or quietly costing you the wealth that future was supposed to hold.